Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, November 8th, 2024. S&P 500 currently sitting at 6,000. I'm David Zarling. I'm here with soon-to-be birthday boy, Ian McMillan. You got plans for your birthday?
Yeah, we got some plans. We'll do some stuff tomorrow for the football game. I think my parents are coming up Sunday after church.
Very nice. That's excellent.
It is.
Got a little early birthday present from Mr. Market.
Mr. Market. How about this guy?
I remember.
Wow,
Yeah.
What a week. What a week.
Yeah, things move slow and then they don't. And last week was Flashback Friday and we talked about the breath thrusts that we saw late last year in 2023. And what do you know? Trends continue to do trend things, which is move higher. Of course, with the backdrop of everyone's favorite topic, the election.
The election, right? A lot of nervousness going into the election. Whether, from what's the market going to do versus personal emotions, I guess, for a lot of people. We had some, I would say, inklings, right? We know that the market is a future discounting mechanism. There had been things happening leading up to the election in certain assets, even, when polls closed at 7 Eastern.
Right.
On Tuesday, and almost immediately you started to see markets move, all different types of assets, stocks, crypto, rates. Through the night, they were all kind of making their stamp, I guess, putting in their opinion on who they thought was going to win. It was a continuation of a lot of those same trends that we had seen. And
I think, and that's where it's important to remember that, going into a president-elect in 2016 of Donald Trump, markets had gone close to limit down, and then we saw subsequently stocks rise after that. And 2017 being one of the least volatile years on record for the market. But it's also important to highlight that this also could have happened if Kamala Harris had won.
Yes. And for clients listening to this, you should have gotten the client letter yesterday. Please read that. No charts. Actually, I think in over 5 years of writing client letters, probably the first letter I've ever written that didn't have a chart in it. I usually got lots of charts because we're a firm that has a technical analysis discipline. But we talk about the election and the reality, and that it's been fun. It's been great. This always has to stick, right, Dave? I mean, we can't just give it all back.
Right.
If the person that you voted for won, that's great. Congrats. The person that you voted for, this could have also happened if Kamala Harris won.
Correct.
Let's all be honest about that. Now, I will say, back to my comment earlier, there were things as Trump's lead in the predictive markets, we'll call them predictive markets. We're not going to talk about polls, but as Trump's lead grew through other measurements, the gambling market, and particularly, you saw these assets move. You saw interest rates go up. You saw Bitcoin start to rally, and you saw stocks continuing to rally. And then we've had the reaction. All three of those. Now rates have come back down a little bit.
Well, it could have gone the other way too. You could have had a president-elect Donald Trump and the market sell off.
Yeah.
There's no guarantee in markets, and we've covered ad nauseum with our clients that there's no presidential party that has a monopoly on market returns. And really, if we were really digging into the data, I know Stock Trader's Almanac by Jeffrey Hirsch does good work on this.
Yes.
What you're really looking for, honestly, is a Republican Congress. And that's not an endorsement of Republicans. This is not a political show. It's just when you look at the data.
It's 100 years a day. Yeah.
Yeah, 100 years. And you look at when there's a Republican Congress, and especially, in situations where it's split, where you have a party in presidential executive power, and then you have congressional power, a different party. Those are actually your better outcomes. And to have a situation where you have a Republican Congress, your average annual returns are much higher.
They are. It's just, and maybe that changed. Maybe going forward, Dave, will be the worst 4 years of Republican Congress we've ever had for the market. That's
Right.
possible.
It's possible.
But the data says you probably shouldn't err on the side of that.
Right. And it's just fascinating how people get caught on the presidential election and not other elections, even your local elections. Yeah, your local elections, what possible connection to a market could they have? But in the end, the impact that you have as an individual around you, the individuals around you, you could have way more impact on your friends and family and community than any president can. And so that's my encouragement to listeners is like, get involved in your community. If you're upset, if your favorite candidate didn't win, go get involved in the community. Don't sit around and anybody's allowed to be upset if their candidate doesn't win. That's fine. But to think that it's going to have ramifications on the market or your life where you can control your life and you can control your interactions and who you pour yourself into, go that direction. Don't go down the executive power thing. You just have to be careful that you don't marry your biases and opinions to the market. Market's going to do what it wants to do, whether you think it's the right direction or not.
Yeah, and I get it. If you were I'm sure there were a lot of people that said, I'm just gonna sit on the sidelines till the election's over. Too nerve-wracking for me, and I don't know what's gonna happen, so I'm just gonna. I guess, are you getting in now?
Well, that again, I know we talked about this several months ago, but you're now caught in a situation where if you haven't been involved, when are you going to get involved? Right here, right now?
Like now, after we're up, we've had the biggest 4-day move in markets since the November 2022, when the S&P bottomed. Now, I wouldn't say it's when stocks bottomed. That's technically when the S&P bottomed. I think there's a fair argument out there that says, quote unquote, stock market actually bottomed a little over a year ago. But the S&P, that index specifically, and the thing is, as we had been in a downtrend going into this, I get not being involved. I get it being a quote unquote surprise to the upside. But that wasn't the case that we have had on Tuesday. If you are an intermediate to long-term trend follower and you're zooming out in charts and you're truly agnostic of what goes on politically, what things go on the headlines, you are tried and true, trend following, I care about price, then you should have been involved. You should have been involved going into Tuesday night in risk on assets.
And the reality of trend following is you got to get involved when it might not feel great from a narrative perspective. And the top's going to happen when everybody and grandma is euphoric. And you're not going to be out an exact top. There's no such thing as the bell ringing at the exact top. And now with S&P 500 being up 38% since the breath thrusts that we highlighted last week that happened in late October, early November of 2023, we've seen uptrends all over the place in many asset classes and most notoriously in U.S. equities. The point being, if you stayed out because you were nervous about hard landing, soft landing, completely missing that the market was pricing in there was going to be no landing, or because of election and your least favorite candidate is now in office or going to be in office, are you really going to stay out of an uptrend because of that? That's irrational and double-minded. And that's why we use price, because price is our emotional bodyguard, right? Price protects us from our own incorrect, irrational opinions about situations. How many times, for example, how many times have we seen the market rally when war breaks out? No one wants war. I get that. I don't want war. But there's plenty of times where negative events happen, quote unquote, negative narratives, and the market moves higher. So your least favorite candidate gets in and the market moves higher. Who's wrong? Well, if price is moving higher, the market's not wrong.
That's reality.
That's reality. And so
I'd rather tell my wife she was wrong than tell the market it was wrong.
yeah. Do you get to do that on your birthday?
No, I preferably neither. Preferably I have to have that conversation with neither. But if I had to pick.
But you're now in a glass box of emotion. If you haven't participated in this and your least favorite candidate won, you will not want to get involved. And we're now heading into the best 6 months.
Yeah, like we just started, and that was the whole thing. I mean, we had a good market reaction in 2020 when Biden got elected.
Correct.
We broke through. We had spent that whole, August, September, October in kind of a wide range. Biden gets elected early November, and we rip higher for a long time. These are not, it could have been, I don't know, Cotton Eye Joe. Who cares who got elected? This is just historically what the market does.
Uptrends are uptrends.
Same
Why
thing.
fight them?
And speaking of these market reactions, how often is it that we get the spike and who outperforms? Small caps, regional banks.
Right.
We're going on like 3-4 election cycles of this. Small caps get the big push, probably going to, if history is any inclination, this probably continues throughout the end of the year. Small cap outperformance, saying that does happen. But again, statistically speaking, this is just how these things tend to get.
Right. And then you see the large caps pick up later.
Yeah. Then we get into the year and kind of people start making more of their more specific bets. Those people that invest based on what they think some policy is going to be bullish or bearish or whatever those people spend their time looking at. But they do look at that. They do have assets. They are market participants. They are supply and demand. And they are investing on those things. They are moving markets based on that. It's not what we do. We kind of let those people make their bets and then follow whoever was the strongest.
So the world's not going to end.
I don't think it is. And it didn't end in 2020. It didn't end in 2016.
Right. And everybody's least favorite character got in office.
Yeah.
Everybody's had a shot at this. Everybody's had a shot at the least favorite getting in.
And how much higher is the market?
Right. And it's a perfect example of our personal biases cannot have any inch in an investment process. It just can't.
Since election night, stock market's up 185%. We've had 2 presidents during that, essentially. 8 years.
And so markets are going to do what markets are going to do. And the table was set back in October, November of 23. We had 2 breath thrusts since then at that point, and then again in July of this year. And we're heading into the best 6 months. And so it's probably hard for investors to envision that this keeps going, but we're also not long in the tooth when we look at average months of a bull market.
No.
Or average all-time highs. I believe we're sitting around 46 or 47 all-time highs, and a bull market year typically sees in the mid-50s. So we might see more all-time highs before the year is over. And is that really a surprise if we're in the best 6-month window? And that best 6-month window is amplified post-election, regardless of who the presidential candidate was or was the presidential elect. The 6 months, November through April, are the best 6 months. And in an election year, they're even more amplified in that direction. Now, I know there's some good seasonal charts out there that, like Zaccardi shared, where typically you rally into the inauguration and then you have a kind of a cooling off period. So we're talking about now through January.
Yeah, that I'm cool with it.
Yeah. And speaking of, go ahead.
I was going to say, I mentioned earlier, since election night 2016, stock markets, let's call it, 200% essentially. Well, I mean, lots of things are up more than 200%. And you've had how many? So you had Q4 2018 drawdown. I think it was technically 20%. Might have been like 19.8 or something.
Yeah, you've had 3 20+ corrections in that period of time.
And we're still up 200%. And every party's there shot at, being the leader, getting their policies, and America, it just trucks through. Don't go look at what's happening in Europe. I'll tell you that. It just gets worse and worse. I know you mentioned earlier to me, Dave, emerging markets, all-time relative lows, Europe, all-time relative lows. I mean, they were a lot of red countries on Wednesday. A lot of those country ETFs were red.
Yeah, not all stocks are the same. And wouldn't you know it, the trend continues there on a relative basis that international stocks continue to underperform U.S. stocks. And we continue to see brand new relative lows from international stocks. And that's why you don't buy and hold international stocks. That's why I use relative strength and ratios.
You do not own that for the sake of diversification. Pointless. That's 10, 20, 30% of your portfolio that could have been in something better.
Right. And speaking of uptrends and downtrends, I do want to highlight the supporter of this podcast, the Adaptive Select ETF, which is listed on the New York Stock Exchange under ticker ADPV, which helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. Distributed by Quasar Distributors, LLC. And so we have this ongoing uptrend. We have confirmation of the uptrend. Do we consolidate from here? We could. It's absolutely an option for this market, considering it had the best post-election move we've seen on record in these first 4 days. Some digestion would be perfectly normal.
And I could say short-term Russell's actually is here on Friday lunchtime. Russell's where the opening gap candle on Wednesday morning, it spent Wednesday and Thursday sideways. It's consolidating up here very nicely.
Well, it'll be information if we zip through these levels on small caps. I can't tell you what the likely scenario is there because we're still at 0% return for small caps since November of 21. So we're sitting on 3 years of 0% return on small caps and haven't reached all-time highs yet. And so do you see an auction process in here that consolidates and confirms the demand in the market? Probably. But if we don't, if we go right through this like a hot knife through butter, that's tremendous information on the risk on nature of this market. And then you look at all sorts of relationships like discretionary versus staples with we're looking at XLY going out to brand new all-time highs for the first time in 3 years. You look at equally weighted consumer discretionary trying to also go out at new all-time highs. You're seeing financials hold up well. The areas of the market that you would expect. I know you did some work this week on the credit markets. When you see junk bonds continuing to outpace the aggregate bond complex.
And what have we been saying for weeks? That there is no sign that, hey, going in this election, you should probably be a little wary.
Right.
None of that. Really anywhere in the market.
And even we've highlighted CCC credit spreads in the past on here, and we continue to see those be cool, meaning like they've cooled off. They've taken another leg lower this week. So we continue to see the green light from credit markets. And then you add in the move we saw to Bitcoin this week.
Huge move.
Now sitting up near, 76,000. And we've talked ad nauseum about the 70,000 level on Bitcoin. And now we're above that.
Bitcoin, yeah. You're breaking out of the, consolidation. We've been consolidating since March. And it was last week, we talked about the chart that was shared, and I apologize, I cannot.
By Larry Thompson?
Larry Thompson, about Bitcoin's post 2012, 2016, 2020, Bitcoin and those were different presidents.
Yep. Different parties, different presidents.
And Bitcoin is consolidated and kind of chilled out leading up to the election. And then it tends to just take off like a rocket. And so far, we are kind of seeing this. Now, when I say take off like a rocket, I mean, we have, in theory, much more to go. I mean, just in 2020, we had a move 350%. We went from 13,000 to 49,000 on Bitcoin.
I mean,
I'm not saying it happens again, but we're 3 for 3 in history
of Bitcoin moving higher after election.
Yeah. And again, it was one of those things where as the results started coming out, it was another risk on asset that was moving. You know what else moved a lot? Election night? Dollar.
What? Yeah. A lot of dollar pairs, a lot of volatility in cross currencies for sure.
And that has led to some weakness from our gold friends. Very much so. I still put gold in the uptrend category for sure. That relative chart just continues to be such a mess.
Right. Well,
not worth.
And I think the big winner from an election standpoint is these betting markets that we did see them in 2016 and 2020, but they've gained more popularity. And what I mean by that is you could take a wager on who. Now, we don't do that. Obviously, that's a betting platform. It's not something we do for our clients, but you could take a wager on who's going to win. And what a perfect example of free markets and price showing and having some predictive power in them, because Polymarket predicted, I forget the name of the third one, all of them weeks leading up to the election were pointing to a Trump victory. And then that night just exploded higher. And so what a testimony to what price is. Because it's one thing to, as an investment manager, to say, oh, I'm bearish. But how are you actually positioned? Are you position bearish? Same thing with a voter. You know how many people you could ask who they voted for and they'd probably lie to you? But when they put their vote in, it's different than what they say. And so these prediction markets where you could take a wager on who's going to win, what a unique tool. And there was an interview there's an individual that placed a pretty large bet on Trump.
Yeah.
I forget if this Polymarket or predicted, and they asked him, how did you come about your process? Well, he used the neighbor theory.
The neighbor method. Yeah. It was the guy from Frame.
The neighbor method, which was rather than asking someone who they're going to vote for, who do you think your neighbor's going to vote for? And what a clever way to identify potentially an edge there. Now that cat's out of the bag as far as the method goes, but maybe
I think mentally it's still usable.
Oh, absolutely. It's definitely a bona fide.
Like a psychological way. That guy put, I think, close to his entire net worth. I think he put in, 30 million?
Yeah, and that's not a recommendation.
He's going to profit, and I think he made 80 million, so he'll profit 50.
Right.
It's good for that guy. Hey, he kept it simple. And look at how much money do they pay these pollsters? And, and
they were all wrong.
And they've been wrong.
Right.
It's
not about what people say, it's what they do. And that's what's amazing about these prediction markets is it's people actually putting money on the line, real money, right? That's a real hurtful potential rather than just saying who. So these, like you said, the real losers are these pre-election pollsters who don't seem to get it right. These predictive markets do. And so it's why we use price. These markets that we look at, they're looking out 6 to 18 months in the future on the prospects of companies, economy, taxation, policy. They're looking at all of these things. And so why would we not study price? If you didn't have a chart of the ability to study supply and demand, you're just making a ill-advised bet, a guess. You can use information to say, is this an uptrend? Okay, let's be involved with it. If it's not an uptrend, let's not be involved in it. Let's not overcomplicate. Life is complicated enough. Why make markets harder than they need to be? And I know, Ian, we talked about, kind of for the past 6 months, the kind of rotation of sectors, and breadth was just fine broadly, but there was no real advantage in one sector over the S&P 500. Has that changed? Are we seeing change, because the foot has dropped and this is where the dust starts to settle. Anything from, a sector standpoint, maybe, the big, what's interesting to me is when you look at the past week, now again, the election was on Tuesday, how much discretionary industrials.
Discretionary for sure. I'll tell you another one, utilities, which had been, there's 50-50 on utility strength, weakness, and for stocks. I will say that I think it's another reaction to how the market feels rates are going to go. Utilities actually, they got crushed this week on a relative basis. Tech, I'm still off the tech train. I say that Magnificent Seven. That's a different story with a different chart. But XLK is a sector. Energy, right? I mean, that was another asset. It's come back a little bit, but we saw oil prices tank on Tuesday night, and they bounced back. We'll see if that does still play out longer term. But that's one of Trump's big things is drill baby drill, cheap energy, and that's a sector that had been weak for months.
Right.
Healthcare, that'll be in South. Is that market telling you, there's been a lot of talk around healthcare in Trump administration. That's another trend that had been in place for months. Financials have held up well. I think so. I mean, they had probably the biggest move on Tuesday, would you say?
Yep.
By far. Gave some of it back yesterday. Again, this is on a relative basis. Basically, financials ended up being flat yesterday where the market moved higher. So gave some of it back. Staples, new lows. Well, that was interesting that did get hit was
okay.
Home builders did not have a good Wednesday. It's just surprising, right? Because now, and I think who was it? I think it was Michael Noss. He's a CMT up in Canada, and he made a good point, something that we love to talk about. And Thursday, if your stock or sector was down, that's a sign.
Right.
That's a sign.
Yeah, when you're weak in a strong tape, you should be paying attention.
Absolutely should be. So I would put home builders on that list. I don't know what the market's trying to say there.
Well, I think we got 11 major sectors. And since election, the top performers are discretionary, financials, industrials, tech, energy, and communication services. Negative or slightly positive returns for healthcare, utilities, and real estate. And healthcare, utilities, and real estate are notoriously your risk-off sectors. And so here we go again with another piece of evidence pointing towards risk-on behavior. And, how bad are things for the market if discretionary is your top performing sector or financials are your top, second best performer or industrials? Like the only ones that have outperformed the S&P during that period were discretionary and financials. And so you sit there and say, okay, more evidence of risk-taking behavior in an uptrend. And you brought up Bitcoin. We haven't talked about commodities other than gold a little bit. Anything we're seeing out of the commodity complex worth highlighting? I think you mentioned energy, so we could, talk about oil.
Yeah, and you've seen soybeans have had a huge move. I mean, there's definitely been some moves. Now, a lot of these were in bad trends to begin with. This is, necessarily the beginning of something new. But other than that, I mean, same with silver, gold, silver, right? That was a relationship that itself hadn't really taken off. You've seen palladium that had a huge move. And is just absolutely, down 20% just this month.
Speaking of being down, how interesting is it to you that something like super microcomputer SMCI gets added to the S&P 500, and since that point of being added to the S&P 500 is now down approximately 80%. And
just unpeaky timing.
Does that make you nervous when the Dow Jones announces they're putting NVIDIA in the Dow Jones?
I knew you were going to get.
And removing Intel.
Yeah, the whole NVIDIA on the Dow. I'm so glad you brought this up. Well, they announced that last Friday.
Right.
And yeah, of course, 4:30 going into the weekend. And just like, you got to be the Dow. Let's just say the Dow does not have the best track record for timing its entries and exits on components.
And so you just pay attention. You pay attention that, the way to use technical analysis is here we have NVIDIA at or near all-time highs. And if it can't hold $130, that would be your first clue. If it can't hold its 200-day moving average, which is currently sitting at 106. If it can't hold those, then that would be information that maybe we have another SMCI on our hands, another supermicro computer. But time will tell. When you look at semiconductors, they have not reached a new all-time high. That would be a potential divergence there when you think about it. Or are they just sitting in the wings and it's the same playbook from the last 12 years, which is small caps lead out of this and then tech takes over?
How about the fact that the most hated bank stock, Wells Fargo, made it to all-time high before a lot of other bank stocks?
Well,
now, am I saying Wells Fargo over Bank of America the last 7 years? No. I'm just saying from a price behavior perspective and the mindset that all-time highs bring to market participant, I think it says something.
It's really hard to get bearish on a market if financials are doing fine, especially some of the worst financials.
Yeah. It is. It really is.
And so here we sit a few days removed from an election.
How can you say that a year in, though, Dave? I mean, we're already up 38%. Whatever we're up in the last if you actually go back to the October 2023 lows.
Yeah, it's about...
S&P is up 45%.
Right. And what's interesting is that's not crazy historically. It's great. There's been history made during this process. And what I mean by that is, for example, the last 4 days being some of the best 4 days at post-election that we've seen. But it's not abnormal when we look at average returns in a bull market.
And you're sitting here telling me that it could just stay just as good?
It could. It won't be. I mean, how many times do we say on here, markets don't move in a straight line, but let's just say the uptrend is intact. And until that changes, there's nothing to do there. You stay participating, and yes, there will be a day, and it could start on Monday. I don't know. I wish I knew the future, that the market starts to correct. And this was a top that you only know the top afterwards. You never sit there and go, oh yeah, I knew that was the top. I remember, I knew exactly when that was going to be, and I pulled out exact top. No, that's not how this works.
I've never been able to do that, to be honest.
Yeah,
I don't think.
No, that's not how this works. The uptrend is intact. There will be a top someday. It could start on Monday, but all signs point to that not being the case. Now, could we consolidate in a 5% range this move that we've had this week? Absolutely. It's one of the better stock market weeks that we've had. And could some digestion be here? Absolutely. That's absolutely possible. And I think that's trouble for an investor who hasn't been involved. And what I mean by that is, if they weren't in this move and we have some type of 3 to 5% consolidation, in their mind, they will say, see, I told you I can't get in. Like, the market's about to roll over. And then in December, if you have another 5% move that you didn't participate in, all of a sudden you're talking about 10% that you didn't participate in because the subsequent days would
ease yourself out.
Yeah, you psych yourself out. It's why we use technical analysis. It's our emotional bodyguard from this type of stuff. And we'll know if we're dropped back below 5640, if we're back below a 200-day moving average, which is currently sitting at 5385, we're back below the April or March highs of 2024 near 52.70. Those are some lines in the sand that we could pay attention to that, maybe because bull markets tend to end when there's an absence of buyers. It's not necessarily an increase in sellers. It's you've had buying exhaustion. And have you pulled all the buyers out of this market? That's always possible. But we'll know that because that dynamic between supply and demand would change. And the first thing that you would clear to the downside is 56.20. And then it would be 43.80. And then it would be 52.70. But we don't know when that's going to happen. We just pay attention to price. And when it does start to happen, you start making adjustments. But for the time being, this remains an extremely healthy market, despite whether your favorite candidate won or didn't win. I know that's hard to hear sometimes. It's really hard to see that your opinion doesn't matter. Like imagine someone came up to you and said, your opinion doesn't matter. Well, that's what Mr. Market does every single day. And it's why I enjoy being in part of them, because I feel like it gives me pretty good thick skin, pretty good discernment.
It does. I agree with that.
It's a humble pie making machine.
And you're only good if you learn to accept to be wrong.
Right.
You'll never survive if you are willing to be like, oh, yeah, I was wrong about this trade, so I'm going to hop on out before this gets worse.
Right. And it's a process. You're never going to bat 1,000. You know, one of our internal teammates here, Benjamin Trock, brings it up in such a great analogy, which is the harder you try when you get up to the plate, you're gripping your knuckle, you're gripping the baseball bat and you're white knuckling it and you're that's actually a detriment.
Rage trading?
Yeah, rage trading or like trying to fix it through effort. Let the market do the work. Let the market carry out its uptrend. Don't make it harder than it needs to be and have a process where if we're above a certain level, let's participate. If we get a 2-0 fastball where you want it, let's crank it. Let's hit it. Let's smoke it. Let it be the fat pitch. But if you're sitting 0-2, yeah, you might have to foul off some pitches before you see that. And it's the same thing in markets. Why fight a trend? Why get up there and white knuckle a trend when you could just participate in it? Just be involved. And so we continue to see that information from the market. There will be a correction at some point. I wish I could tell you, Ian, and everyone listening when that is, but it wasn't this week.
It's not this week.
And with the VIX now sitting near 14,
I was going to bring that up. We've got lowest since July on volatility, or we were at one point today.
And if that continues to move lower towards the lows of the year near 12, are you now talking a melty type environment where we don't
about where you're just up 20, 25 bips a day?
Right.
It's boring, but it's one of those things where it goes back to the situation we just talked about. Now where you get it. If you're just going to trickle higher, for a lot of people, then it's even worse.
Right.
So everyone says, I'll do it on the first correction. And then Mr. Market, like he always does, just never gives you the correction till you're much further down the road.
Yep. And we'll see how this plays out, but the data and the evidence continues to stand that we're in a rising trend, an upward trend, a risk-taking environment. Anytime you have the credit market pointing to this and stocks matching that behavior with your risk-on sectors doing well, continues to be a U.S.-centric market, we can't fight it. It would be irresponsible. It would be not in the best interest of our clients to fight this market. Let's wait for when we have downtrending information, when we see a spike in credit spreads, when we see junk bonds roll over versus aggregate bonds, when we see price levels break to the downside. We'll be the first to highlight it on this show.
Yeah.
But for the time being,
anything that we aren't we said that for years. We don't get on here and BS you, and then we go back to our market calls and do complete opposite of what we talked about.
Right. We're just here to highlight the information at hand, and the information at hand is we have an uptrend was confirmed this week. Yes, there was an election. I'm not here to tell you can't be sad if your favorite candidate didn't win, but as we talked about before we got on here, I'd like to think that there's way more important things in life to be sad about than an election. So while you're allowed to not like a candidate who gets elected, you do get to appreciate the other things in your life that are more important. And you do get to appreciate a market that continues to move higher. And just let's use technical analysis to be our emotional bodyguard. Let's let the adaptive process be our emotional bodyguard to protect us from our own selves, regardless of our opinion.
I can't tell you
the
how
camera is.
it's protected me.
Yeah.
It's not like I'm immune to emotions. I'm still a human.
Right.
Still have an opinion on, oh, I bet this stock's going to do this, or I think that could be good for this group of stocks. Does that mean that gets implemented? No, it stays a personal opinion. I mean, doesn't it end up like price chart tells you, yeah, you should get involved here. That's another step, but I can't tell you how many times. I mean, I was willing to accept Wednesday morning, going into Tuesday night, that Wednesday morning, knowing how we're positioned, we could get crushed.
Because we were up.
Same risk take every night as the market closes. Yeah.
Well, it's because we were in an uptrend. You weren't positioned that way because we were in a downtrend.
There was this event. Actually, and speaking, I didn't even know we lowered, I had no idea we lowered interest rates yesterday until like 7:00 in the evening. It's not little I care about these events. It's just an event. Now, as a U.S. citizen, no, it's not just an event. As a market participant, it's just another blip on the radar in the middle of an uptrend.
We want to focus on the signal and avoid the noise. And the signal is price, and the noise is the narratives. And price moves first, and then we get the narrative. And so we'll see where we are 6 months from now, right? We're heading into this seasonally strong period, and will be noticeable if this 6 months is not strong. It's off to a good start. Doesn't have to stay that way, but that will be information if we're breaking the levels we just talked about. That'll be information in this environment because it's quote unquote supposed to be strong. And when it's not, that's when you pay attention. And so time will tell. But Ian, I appreciate you being on here. You always do a great job. Your letter to clients was fantastic. Just reminding them that regardless of the outcome of the election, we're going to be okay. It's one of the things we can be thankful for. We live in a great nation. We can still have polite discourse with each other, share a beer. We get to be thankful for our veterans this next week. And so make sure you thank someone who served this next week, that they fought so that we could have these emotions. So that we could cast a vote. We could be thankful that we cast a vote. Many countries, that might not be the case. And we could be thankful for that. And we could be thankful that we could be participating in markets that protect our purchasing power. And we can hug our loved ones and spend time with them because that matters more than any market. So I hope those listening to this, we gave you great information this week. If you liked it and appreciate it, please do share it. It helps us get the word out. It's a compliment to us. You give us high rankings on whatever your favorite podcast platform of choice is. But Ian, I hope you have a wonderful birthday with your family. I can't wait to hear about it.
Have a great weekend, everyone.